Welcome back to Economic Outlook. In my previous entry, I introduced the concept of carry trades and gave an example of a carry trade executed using the Japanese yen and the US dollar. The structure of this trade raises several important points and questions, and in this entry, I want to examine each of these features in detail. We'll start by looking at the sensitivity of a carry trade to changes in the foreign exchange rate between two currencies. First, the success or failure of a carry trade is heavily dependent on the foreign exchange rates present at the inception and closing of the carry trade. If the spot rates are nearly the same, or if the original currency depreciates relative to the second, the investor will make money on the carry trade. Conversely, if the original currency appreciates relative to the second, the investor might lose money. In the previous example, the investor was successful with a final spot exchange rate of 119.45 yen per US dollar. However, if the exchange rate fell to 115 yen per dollar, which it actually did in September of 2003, just 3 months after the trade, then the entire trade would have lost money for the investor. Carry trade sensitivity to exchange rates raise a second important point. Carry trades help create very efficient markets. As you can see from this example, it might be possible to use carry trades to create a true riskless arbitrage opportunity. The firm could purchase a forward contract for the currency at the time the trade is created and lock in its future profits. This happens occasionally and is called covered interest arbitrage. However, the forward market for currencies anticipates differences in interest rates to properly price the contracts. It's extremely difficult to find these arbitrage opportunities, and when they do exist, they're quickly exploited, leading to a return to balance for forward contract exchange rates. This suggests an important question about the relationship between the spot rate of a currency and the forward rate of contracts. If two currencies can be invested for different interest rates, why does the future spot price not always reflect this difference? A theory called the international Fisher effect suggests that foreign exchange rates should shift over time in direct proportion to the nominal interest rates in two different countries. In the example, interest rates in Japan were lower than in the United States. According to the international Fisher effect, dollars should buy fewer yen at the end of the trade so that the profit from either strategy is equal. The long-term relationship between the yen and the dollar seen in the chart reflects this reality. The value of the yen rises relative to the dollar at the same rate as the difference in interest rates. However, in the short term, this relationship does not always hold. A major cause is the structure of carry trades themselves. When firms initiate carry trades, they borrow and then sell the currency on the spot market to buy the second currency. Gradually, carry trades weaken the original currency that is borrowed, in this example the yen. When the currency weakens, its exchange rate depreciates, helping to offset the gains predicted by the international Fisher effect. Frequently, this results in the currency maintaining a steady exchange rate, rather than gaining value versus the second currency in the trade. Other factors come into play as well. For example, a country might decide that it needs to strengthen the competitiveness of its exports. This benefits carry trade participants because the original country will intervene into currency markets to help depreciate its own currency. This makes exports more cheap and attractive to foreign companies, and helps carry trade investors because it's easier to repay the original loan and to make a higher profit margin on the trade. This very thing happened in Japan and several other East Asian countries as they grew exports and needed to keep their currencies cheap to continue growth. The scope of financial forces at play for a carry trade raise a fourth important point. Typically, only large institutional investors can successfully execute a carry trade. Firms like investment banks are able to lend and borrow at rates much closer to the Fed funds rate or the applicable interbank rate in the other country involved in a carry trade. Their transaction costs are lower, and they have the financial resources to make a carry trade profitable. Retail investors don't have the kind of information or lending facilities to typically execute carry trades. Now that we've seen how carry trades are structured, we can examine the implications of dollar denomination. As we've seen before, national interest rate policy is critically important to executing carry trades. To help ease the liquidity crisis in 2007 to 2009, the United States Federal Reserve lowered its overnight lending rates to almost zero. This has fueled growth in dollar-denominated carry trades, and these have large implications for broad sectors of the United States economy. Institutional investors are taking advantage of low rates to borrow dollars and invest them in a variety of asset classes. All of this borrowed money needs a home, and many people believe a lot of the money is flowing into equities. Some have estimated that equities could be overvalued by as much as 10 to 20% because of cash inflows created by carry trades. There's probably some validity to this opinion. Carry trades rely upon weak currencies, and the dollar has certainly depreciated relative to its peers. Equally important is the posture of the Federal Reserve. As long as interest rates remain near zero, the value of the dollar will stay low and help fuel trades. Eventually, this posture will change, and the dollar carry trade positions will need to be unwound to avoid heavy losses as the currency appreciates. Experts note that unwinding carry trades will pull dollars out of equities to repay their original loans. This will necessitate the correction in equity prices that many observers fear. Measuring the severity of the problem is difficult because no one is sure how much dollar-denominated money has been generated through carry trades. The phenomenon of dollar-denominated carry trades reflect a more general concern with Federal Reserve monetary policy. After the crash of the technology bubble and the September 11th terrorist attacks, the Federal Reserve lowered overnight rates to almost zero to help stimulate equity prices. This worked, but it also indirectly fueled the housing bubble. Now, observers worry that low interest rates may be precipitating another problem. The Federal Reserve is faced with a classic dilemma. Can it stimulate equities with low interest rates while preventing speculation from lower borrowing costs? Are the consequences of dollar-denominated carry trades as severe as the housing bubble? And as some experts argue, will it cause a further shift away from the dollar as the world's primary reserve currency? No. Dollar-denominated carry trades have caused problems, but they are much less intrinsic and important than those caused by the housing bubble. The likely correction will be much more contained. Additionally, dollar-denominated carry trades will have a much shorter shelf life than the housing bubble had, because the Federal Reserve will eventually change its monetary policy. This restrains the overall effects from dollar-denominated carry trades. However, it doesn't completely mitigate them, and there is probably some validity to the argument that equities are overvalued right now because of dollar-denominated trade activity. More important than the carry trade itself is what it represents. Recovery in the United States is still in its early stages. Economic and technical indicators are improving slowly. Better earnings quality is more likely a result of cost-cutting than of true market strength. Investors should be wary of any over-advancement in equities, or in any market for that matter. They should also be aware that other factors, like increased dollar-denominated carry trade activity, may be magnifying market trends. Thank you as always for joining me here on Economic Outlook, and I hope you've enjoyed this series on carry trades and have found it informative. Be sure to check out my website for more information at www.econoutlook.com. I'll be back next week with a look at how China uses energy and at how yet another magazine has managed to err when it reports on energy consumption. Thank you as always, and I'll see you next time.